Hello and welcome to the Commodities Institute podcast. I'm Emily Costa and today is Tuesday, March 3rd, 2026. What a start to the week. Across oil, gas, metals, agriculture and freight, markets are reacting to one central development, the escalating conflict involving Iran, the United States and Israel, and the growing uncertainty around the Strait of Hormuz, the narrow waterway that carries roughly 1/5 of the world's oil consumption and enormous volumes of liquefied natural gas. Let's begin in oil. It is where the shockwave was felt first. Brent crude futures surged nearly 10% this week, climbing to just under $78 a barrel, and at one point trading above $82 intraday, the highest levels since early last year. The catalyst was not just rhetoric, but physical disruption. Vessels moving through the Strait of Hormuz were struck, shipping slowed to a near standstill, and Iran publicly declared the strait closed, even as US officials disputed that characterization. For energy traders, what matters is risk, and risk is suddenly very real. The benchmark freight rate for very large crude carriers, those massive ships that carry around 2 million barrels of oil from the Middle East to Asia, doubled in a matter of days. On the world scale measure, the key TD3 route surged to an all-time high equivalent of over $423,000 per day. That is not just volatility, that is stress in the arteries of global energy trade. And it is not just crude oil. Liquefied natural gas shipping rates jumped more than 40% in a single session. Atlantic Basin LNG freight rose to more than $61,000 per day, while Pacific rates climbed to about $41,000. Analysts warn spot rates could push above $100,000 per day if vessel availability tightens further. Why? Because Qatar, one of the world's largest LNG exporters, halted production after drone strikes hit facilities at Ras Laffan. That matters enormously. Qatar accounts for roughly 20% of global LNG supply. When flows from that scale of producer pause, even temporarily, it sends a tremor through Asia and Europe alike. European natural gas prices reflected that anxiety immediately. Benchmark Dutch TTF contracts surged more than 30% at one stage as traders recalibrated expectations for storage refilling ahead of next winter. And here is where the story becomes more nuanced. Europe entered March with gas storage levels significantly below seasonal norms. Germany, the continent's largest gas consumer, began the month with inventories around 27% of capacity, compared to an average of roughly 64% for early March in recent years. The Netherlands was even tighter, near 10% capacity. That means European buyers may have little choice but to bid aggressively for LNG cargoes, even into a rising market. Now contrast that with China. China is the world's largest energy importer. On the surface, that sounds like vulnerability. But in this particular crisis, China may be unusually well positioned. Last year, China built substantial crude inventories. By some estimates, its surplus crude, calculated by combining imports and domestic production, subtracting refinery throughput, averaged over 1 million barrels per day and possibly closer to 2 million barrels per day in the opening months of this year. Imports surged late last year, hitting a record above 13 million barrels per day in December. Refiners took advantage of discounted Russian and Iranian barrels, building both commercial and strategic stocks. That gives Beijing options. It can reduce imports in the coming months, cushioning itself from higher spot prices. Or it can maintain high refinery runs and export refined products such as diesel and gasoline into a tightening Asian market. Since domestic fuel prices are state-managed, Chinese consumers are shielded from the immediate inflationary effects that may hit Europe and the United States. The same flexibility extends to LNG and coal. China relies heavily on long-term LNG contracts, many of which are oil-linked or fixed price. In times of high spot prices, it can scale back discretionary purchases. It can also resell cargoes. And as the world's largest coal producer and importer, it can increase domestic coal output to offset expensive gas in power generation. So while global benchmarks are surging, China may emerge not as a casualty, but as a relative beneficiary. Let's pivot now to metals, where the Strait of Hormuz risk is creating ripple effects. Japan, a key benchmark buyer for aluminium in Asia, saw global producers pull or pause their second quarter premium offers. Companies including major miners had proposed significant premium increases over London Metal Exchange prices for April to June shipments, but withdrew or allowed offers to expire as they reassessed shipping risk through the Gulf. Japan imports roughly 20% of its primary aluminium from the Middle East. Even if production in the United Arab Emirates and Bahrain remains unaffected, shipping delays alone could tighten regional supply and push premiums higher. And then there is steel. China's steel exports to the Middle East have become a critical outlet amid rising trade barriers elsewhere. The Gulf region accounted for about 16% of China's steel exports last year. Now, with vessels unwilling to transit the Persian Gulf and insurers withdrawing coverage, some Chinese exporters have stopped making new offers altogether. No vessel availability means no freight guidance, and without freight guidance, pricing becomes guesswork. In the short term, that could mean lower Chinese steel exports and added domestic supply pressure, potentially weighing on local steel prices. Let's move into agriculture, where the tone is more measured but still important. In the United States, the Department of Agriculture set crop insurance base prices for the upcoming season at $4.62 per bushel for corn, the lowest since 2021, and $11.09 per bushel for soybeans, slightly higher than last year but still historically subdued. Crop insurance pricing influences planting decisions. The USDA projects corn acreage will decline from last year's 89-year high of nearly 99 million acres to about 94 million, while soybean acreage could rise to 85 million. Meanwhile, in Southeast Asia, Malaysia's palm oil stocks are expected to fall to a 4-month low, around 2.63 million metric tons, as seasonal output declines outweigh slower exports. Production is forecast to drop nearly 18% month-on-month in February. And in wheat, Saudi Arabia purchased nearly 800,000 metric tons in a recent tender above the initial target. Traders expect a significant portion to originate from Russia and the Black Sea region. Notably, the volume increase was moderate, suggesting buyers are cautious, but not yet in panic mode over Middle East disruptions. Finally, we need to talk about shipping more broadly. Roughly 10% of the global container fleet is now caught up in Hormuz-related backups. Around 100 container ships are among the roughly 750 vessels affected. Major carriers have stopped booking cargo to the Middle East. Maritime insurers have ceased covering voyages through the strait. If this persists, the implications extend far beyond oil and gas. Containerized goods, everything from electronics to machinery, could back up in European and Asian hubs. Freight rates could climb, and energy prices would layer on top of that, amplifying inflationary pressure worldwide. So where does this leave us? At the center is a narrow strip of water between Iran and Oman. The Strait of Hormuz has always been strategically vital. Today it is once again the fulcrum of global commodity markets. Oil prices are higher, LNG freight is surging, European gas storage is under scrutiny, aluminium premiums are in limbo, Chinese steel exports are stalled, and container shipping faces renewed congestion risk. Yet within that turbulence we see divergence. Europe appears exposed on gas, China appears buffered on oil, where agricultural markets are watchful but not yet panicked. As always in commodities, logistics is destiny. When ships stop moving, prices start moving. We will continue to monitor developments closely because in markets like these, conditions can shift not in months, but in hours. That's all for today's episode of the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review. Thank you for listening. I'm Emily Costa. Stay informed, stay analytical, and I'll see you tomorrow.